Welcome back. Christina, what are the prospects for a recession over the coming quarter or so? And you see it as bumpy, not soft or hard. What's going on?
Well, we have to recognize that there has been a significant impact on the U.S. economy. It just hasn't shown up yet. But you don't have the level of aggressive tightening over such a short period of time without some issues arising, some headwinds created for the economy. And I point specifically to the tightening of credit conditions as a catalyst for a weakening of the U.S. economy. That coupled with just higher rates in general, which is certainly putting pressure on businesses that have to take out loans. So that's a combination that is slowing the economy. I don't think it sends us into a significant recession, but I don't think that it creates a soft landing. I think it would be too optimistic, almost Pollyanna-ish, to think that the U.S. economy gets out of this completely unscathed. There will be damage. It will probably be more centered around businesses as opposed to households, just given that households are in a good place and the labor market remains very tight. But this is not, to me, an environment in which we see any kind of significant recession or we see a very soft landing.
In terms of consumers, should they think about being in cash?
I don't think so, because what typically happens is that markets tend to discount a recovery 6, 9, even 12 months in advance. So we have to assume, or at least I'll assume, that once there is clarity that the Fed has ended its rate hike cycle, that is likely to be a time when markets start to discount an economic recovery, or soon thereafter. So in the meantime, we could see volatility. Defensive positioning will probably be more beneficial within stocks as well as within fixed income. So that would mean, heavy on treasuries and investment grade and fixed income, perhaps shorter duration, but within equities, large caps, more defensive, secular growth. But once we get that clarity that the Fed rate hike cycle has ended and markets start to discount that economic recovery, that's when I think we'll see small caps perform better, cyclicals perform better within equities. And in fixed income, I think investment grade will still look attractive, but that's when munis, high yield, emerging markets debt are going to look more attractive. And also when non-US stocks are going to look more attractive, because I would anticipate that the US dollar starts to weaken once we have that clarity on the end of the rate hike cycle.
Thank you, Christina.
Thank you.
Get today's business news as well as the stories behind the headlines at QZ.com.